Hi everyone, I'm Andrew, and today I want to talk about managing your portfolio in a tax efficient way. And if your advisor has said things to you like, I don't really want to discuss taxes, I'm not qualified to talk about taxes, refer to a tax professional, I would absolutely recommend finding another advisor. And if you yourself are not looking at the implications that different moves and trades and investments that you're doing have on your tax liability, I would absolutely suggest that you start to do that. I'm going to give you the basics to do that in this video. So when we're talking about taxes, there's really two main categories on how your dollars are going to be assessed. There's ordinary income, and then there's long-term capital gains tax. So I want to start with some very basics on ordinary income, which is what is on the screen right now. These are the 2023 ordinary income tax brackets. Now keep in mind that here in the US we have a progressive tax bracket. So let's say you make $300,000 per year. Yes, you're in that 35% tax bracket, but not all of your dollars are going to be taxed at 35%. You're going to have dollars taxed at 32, 24, 22, 12, 10%. In fact, the minority of that 300,000 is going to be taxed at 35%. So what qualifies as ordinary income? There's a couple categories. Of course, any income that you make, let's say from W-2, from your job, rental income would fall into there, but also any interest or dividends that are paid from a stock, for example, are going to be taxed as ordinary income as opposed to capital gains. Also, any short-term capital gain that you have from a trade or an investment in a non-qualified investment account, non-qualified account just meaning a taxable account, individual account, brokerage account, trust account, those short-term gains are going to be taxed at your ordinary income tax bracket for that year, and they're going to be taxed at your highest one. Short-term capital gain meaning a position that you bought, held it for less than 1 year, and then sold it. So under 1 year, short-term capital gains. So let's say you're that individual with $300,000 per year income, and you buy a stock and it goes from $100 to $110 in 2 months. You have a $10,000 short-term capital gain, which is now going to be taxed at 35%. So keep in mind, this is why especially individuals in the higher income tax bracket usually want to avoid short-term capital gains because they are taxed so high. Same thing with interest and dividends. Anything that's generating income in a non-qualified account, you're going to be taxed at 35% if you're making $300,000 per year. Now, I want to say that when it comes to IRA, Roth IRA, 401k, they do not apply to this, which actually presents an opportunity for an investor, because if you have the option to, let's say, buy a stock that pays a 4% dividend in an IRA versus a non-IRA, you're going to want to buy it in the IRA because that income is not going to be taxed at all. What's in an IRA is taxed very differently. You're putting pre-tax dollars into that IRA. The government is allowing those investments to grow, whether it's capital gains, short-term capital gains, income, dividends. None of that is taxed in that given tax year. In fact, it's not taxed until you're over 59.5 and you take that money out. At that point, in the year that you take it out, let's say you're 62 years old, and you take $100,000 out of your IRA. Well, in that scenario, you're going to be within this 24, if the tax brackets are the same, which they're not, they're going to be higher. But let's say they were the same, you'd be touching that 24% tax bracket. So you take the $100,000 out of your IRA, about $4,700 is going to be taxed at 24%. Most of it is going to be taxed at 22%, and a little less than half at 12%. It's not as good as a deal as some people think. The government is really saying, we'll let you skip the taxes now so that that money can grow and build up faster so that we can get a larger chunk in tax revenue based on ordinary income tax when you do retire. So let's move over to capital gains, specifically long-term capital gains. So we know short-term capital gains are taxed at ordinary income rates, which for most investors is certainly going to be higher than the long-term capital gains tax. So right now in 2023, long-term capital gains, again, they're based on your ordinary income for that given year. Most folks are going to fall right here at 15%. If your income is between $44,000 and $492,000. But let's again say that $300,000 per year earner, you would much rather have an investment long-term getting taxed at 15% versus that's going to put you, if it's a short-term capital gain, in the 28 to 30% tax bracket. So this is why when you're managing a non-qualified account, an individual account, a joint account, a brokerage account, a trust account, a corporate account, especially if you are a moderately high income individual, you're going to want to avoid short-term capital gains and try to wait until you have a long-term capital gain that you can capture. Now, the other strategy is tax loss harvesting, which really should be done every year, where you're allowed to, let's say you have an investment account and you've realized long-term capital gains of $100,000 throughout the year, and now we're in November, we're getting close to the end of the year. Well, you can go in and create some losses, meaning sell positions that are in negative territory and use those losses to offset those gains. So let's say you have a $100,000 capital gain and you have $30,000 in unrealized losses. You can simply sell those positions with the unrealized losses, now making them realized losses, put that $30,000 towards your capital gain, and now you've reduced your capital gains tax liability to $70,000. If you had $100,000 in losses, you could do all of them and create a scenario where you have zero capital gains tax liability for that year. And yes, you can also use short-term losses to offset long-term capital gains. So short-term losses are going to be more valuable because remember, most likely based on your income, they're going to be taxed at a higher rate. So if you can take a short-term loss to offset a long-term capital gain, you're going to get more bang for your buck there. Now, if you have more losses than you do gains, you can only carry forward $3,000 of that towards the next tax year. So let's say you have $100,000 capital gain and $110,000 in losses, and you go ahead and you realize that whole $110,000 in losses. Well, you've eliminated your $100,000 capital gain. For one, you went 10,000 over, in fact, so you can carry 3 of that 10 over for next year and use it next year to credit toward capital gains. But that other $7,000 goes to waste. You'll never be able to use that again. So it's really a balancing act that you want to play between long-term gains, short-term gains, and managing the portfolio, especially at the end of the year, where you're selling positions that maybe shouldn't be part of your strategy anyway going into the next year. One strategy a lot of investors have a difficult time following is to keep your winners, cut the losses on your losers. I see a lot of investors do it the opposite way. They buy a stock, stock goes down. It's difficult to say, hey, I was wrong, or the data has changed. Let me go ahead and sell this at a loss and move on. A lot of investors want to keep that and say, well, I'll sell it when it gets back to what I paid for it. It's a very bad strategy. In general, it doesn't work, as you know, because that stock may never get back to where you paid for it, where there may be something better out there where you could sell it, take that money, and have it perform going into the next year. So when you're realizing short-term or long-term capital gains, there's always going to be a tax liability. It just depends on what type of gain it is, on how those dollars are going to be taxed. I do also want to mention, if you do tax loss harvesting, whenever, at the beginning of the year, at the end of the year, there's something called a wash sale. So let's say I own Amazon, doesn't matter if I've owned it for 10 days or a year, and I am at a loss in the stock, and I want to sell it to create that loss to offset some other gains. If I sell it, I cannot, well, I can. If I buy that stock back within a 30-day window after the sale date, it creates what is called a wash sale, which is where they do not allow you to realize that loss for tax purposes. So if you sell a position, you cannot buy it back within 30 days, or you don't want to. If you do, your strategy is not valid. So if you plan on selling something and think that the next day I can just buy it back, it doesn't work. You'd have to either go into another stock within that 30-day window, or just wait the 30 days and then you can repurchase that same stock and still be allowed to take the original loss. So I hope that this was helpful. These are just kind of some of the basics on what you want to look at when you're looking big picture at your investment portfolio. Thank you for watching, and I hope you enjoyed.